From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, May 29th, 2026. Let's see what's on the calendar. Your Milwaukee Brewers head down to Houston for a 3-game series against the Astros. If you're staying local this weekend, the Henry Meyer Festival grounds are hosting the Milwaukee Barbecue and Brews Festival on Saturday. It's right on the lakefront, featuring some of the best smoked meats and craft beers the city has to offer. And if you're looking to add a little permanent artwork to your life, you can catch the buzz at the annual Milwaukee Tattoo Festival happening at the Baird Center downtown. Barbecue, beer, and tattoos all in one weekend? If that doesn't scream summer in Wisconsin, I don't know what does. Hey, just maybe get that tattoo before you sample too many of your favorite brews. In Atlanta, some Waymo cars, the driverless ones, made headlines a while ago when they began to circle a neighborhood cul-de-sac for hours with no passengers. I feel like they must have been trying to channel their inner Clark Griswold. Hey, look, kids, there's Big Ben, Parliament. Well, apparently the neighbors eventually tried to block the street with one of those plastic neon green children at play signs, which just caused 8 driverless cars to completely freeze up in total electronic panic. It's comforting to know that at the peak of modern artificial intelligence, it can all be defeated by a piece of plastic from Toys R Us. Finally, some impressive culinary news out of Mexico, where local farmers and residents have officially shattered the world record for creating the world's largest serving of guacamole. Over 1,000 local growers gathered to celebrate with a single bowl of guac, whatever it is, weighing in at least 15,000 pounds. 15,000 pounds of guacamole. I can only imagine the sheer panic at the local grocery store when someone tried to order enough tortilla chips to handle it. Well, at the table today, we have Kendall Bauer, Tom Booth with his first appearance on the show, myself, Art Rothschild, and now looking back at the week in review, here is Kyle Tetting.
Well, thanks, Art. Thanks for filling in for the Open this week. A strong week overall to put the finishing touches on a strong month for the markets. The Nasdaq up 2.4% this week, up 629 points. The S&P up 1.4%, adding 107 points this week. And the Dow Jones Industrial Average added 0.9%, adding 363 points on Friday, 453 for the week. For the year, Nasdaq now up 16.4%, the S&P up 11.2%, and the Dow up 6.9%. Art, it's hard not to start the conversation just looking at how good of a run it's been for stocks. There are all kinds of long-held adages about the seasonality of markets, and perhaps another reminder that being an investor isn't about following some rule of thumb or some general bit of wisdom, but about actually looking at what's out there and maybe having a plan for what we do next.
Yeah, one of my favorite adages of all times that's typically wrong is sell in May and go away. And as you just alluded to, that sure would have been a mistake this time around. So in short, don't follow, just adages as you discussed, as you mentioned, as we talk about every week. Have a plan, have a clue. I think the biggest surprise of this year is how the market can keep going up despite concerns about artificial intelligence, despite concerns about how artificial intelligence is going to disrupt traditional software companies. People are going to be on the streets looking for jobs, all these things. And now even the chip stocks, speaking of guacamole, have joined in. And I'm not talking Frito-Lay here, or Pepsi, or whoever, but there's a war going on, and higher inflation, higher prices for oil, and concerns that you guys are going to talk about later. How long is this going to last, and why are stocks going up? Isn't there anything else to do with money?
Well, maybe there is, and we can certainly talk about that. But in a lot of cases, maybe there's a reason why we don't want to do something else. We all sitting around this table, at least, are believers in stocks for the long run. We're believers in this idea that businesses, especially here in our country, are really good problem solvers. And there are no shortage of problems out there right now. And how do I, as an investor, participate in the economic gains that come from solving those problems? Well, I invest alongside the other business owners in figuring out what comes next. I think one of those big problems that we keep looking at is this kind of ongoing war in Iran. And Tom, we've looked a lot at kind of the oil price conundrum, the hope that maybe there'll be a near-term end to the war, offset by the fact that perhaps oil prices stay higher for longer, even if we do get that end near-term.
So yeah, the price of oil has been high because of Iran, but it's hard to say how long they're going to be higher for. But like you said, it might be higher for longer. I was reading an article from the Wall Street Journal over the weekend, and in it they said that the U.S. Energy Information Administration recently forecasted the price of Brent crude to average $89 per barrel at the end of the year. They finished the week at $87.70. So they kind of anticipate the prices to be higher for longer. It'll take a while to get back to normal. Definitely, it will take a very long time to get close to where it was at the beginning of the year, with it being $60 per barrel. And they also anticipated at the end of 2027 that the price of a barrel of oil would be $79 for Brent crude. So.
Yeah, I think part of the challenge we face is that while we are energy independent in our country, the oil markets are a global market. And so more demand with less supply, even if there is more supply here, and there really hasn't been a huge uptick in supply here, but even if there's more supply here, that supply just now has to go to meet the demand that's not being met by supply from other places. And so part of the challenge, I think, of course, is that yeah, okay, we have this global demand, but then the other part is that these supply chains do not change overnight. It takes an extended period of time to get a tanker out of the Strait of Hormuz and now to the Gulf of Mexico to fill up in Louisiana, to fill up in Texas and Houston, and then go deliver to Asia or to go deliver to Europe. Well, that's a 60-day trip now instead of a 25 or 30-day trip coming from the Strait of Hormuz, and so you've committed those ships now for an extra month. Oh, by the way, they don't know where they're going next, and they might be contracted for some period of time. And so I think there is kind of this lag in supply chains coming back to normal.
I think the other perspective on it, too, is how those higher energy costs bleed into earnings. Oil prices go up. It affects other parts of companies' businesses, transportation, deliveries, and those costs trickle all the way down through the bottom profitability of companies. So that's another correlation why you see when oil prices skyrocket like they did when the war broke out, how the market starts to forecast, okay, how is this going to impact earnings and profitability of these companies 6, 12, 18 months from now?
Yeah, and we've talked a little bit about it's not just oil and gas, it's the byproducts of oil and gas, it's the fertilizer we get from the Middle East for much of the world, and that impacts food prices, it impacts crop yields. And so I think there is kind of this long list of problems that need to be solved beyond just a peace deal. Ideally, right, we'd all like to have peace. Even if we can't have peace, if we can get some kind of treaty that allows ships through, well, it doesn't mean that overnight the problem is solved. It means now we get to work on solving the problem. Again, I think as investors, we're all looking for what long-term does that mean for our investments. I think as humans, we're a little bit more concerned about all the near-term consequences that are taking place from a humanitarian perspective, from a kind of global food supplies perspective. So I think, again, one of those stories that's yet to be completely digested.
And I think, too, to pivot here into some concerns about the spending involved could be impacting, the rising rates and treasury yields that we've seen this week.
Yeah, I'd like to comment, though, on the longer-term picture here, which you're alluding to. I mean, right now, it's been fascinating to watch. There's only been 6 weeks or 2 months that this war has been going on. So for one of the first times in real time, we're watching a war start and supposedly end sooner rather than later. But as you guys have discussed, we're going to have higher prices. It's going to take longer to get things to places. Oil prices are going to be higher. Interest rates are going to potentially be higher. Inflation is higher. And we're focused on the negatives, but the market keeps going higher. And I think it's because investors are digesting the fact that inflation, higher inflation, isn't all that bad. It means company can charge more for their products. They're going to make more money over time. This is the reality, and something I call creative destruction. All these bombs that have gone off, all these defensive missiles that have been shot up have to be replaced. So you can see businesses across this country revving up to replace those. It's another cycle, very similar to what happens in a hurricane. You get destruction in an area, now people need new cars. They need contractors to come out, fix their roofs. So this war may turn out to be a good thing, ultimately for the economy, as sad as it is to say.
No, I think that's fair to an extent, and I think the other thing it does is it really separates the strong from the weak, right? When you look at periods of volatility caused by this kind of uncertainty, this kinds of chaos, the businesses that aren't strong enough to survive, the houses that can't stand up to the winds of the hurricane are the ones that get knocked down. And the homeowners realize if they're going to rebuild, they got to rebuild stronger. And I think in this case, with this war and potentially the higher inflation, yeah, it can be a good thing for those businesses that have pricing power, for those that can be price takers instead of price givers who can pass along those costs. But the hard reality is that there are a lot of businesses out there that aren't going to survive because they probably shouldn't have survived long-term anyways. And so I do think for active investors, I think for people who look more broadly at markets and say, well, there are winners and there are losers, and I'd like more of the winners and less of the losers, there's opportunity in that. There's opportunity for the investment firms that look beyond just the index and say, well, how do I avoid some of that risk? The index is great. It's good broad exposure. But again, I think we can be more risk conscious in a market like this and get the benefit of maybe some more downside protection. One of the things that's come out of this, Art, is no shortage of commentary on what the right balanced portfolio looks like. You pointed to an editorial in the Wall Street Journal and some of your notes ahead of the show that suggested that maybe the typical 60-40 is not the best approach in every environment.
Yeah, it depends on who's talking. The guy who wrote that editorial happened to be the former president of Fidelity Investments. They make more money off of stock funds than they do bond funds. But the facts don't lie. Over time, you're going to make more money in stocks. But the real question is, what's going to keep you in the game? And for my money, and another article, of course, talked about you're even better off if you have, again, 90% of your money in stocks and 10% in money markets, and forget about bonds. Now, that's not my opinion. That's the opinion of this particular article. Again, hindsight's 20/20. For my money at my ripe old age, I want to have plenty of cash. I don't want to have to worry about things going up and down, as you and I have discussed before, on a short-term basis. Over the long haul, absolutely. I love stocks, but it's not one kind of stocks. It's not just the S&P 500. This year, as we've discussed, emerging markets have done exceptionally well. Past few years, global stocks have done exceptionally well. So I want to spread it around. Value stocks. Nobody's talking about those because the tech stocks have taken off over the past 6 weeks. But before that, it was nice to own those value stocks that are still ahead, for the year. So spread it around. Don't listen to any article. Listen to us. We'll tell you, how you should be invested. That's what we're here for.
I will say, to come to the defense of the bond market, as the young guy here who would be more risk prone, remember too, yields going up because there's this, bonds are selling off also presents an opportunity for new money going into the safe part of your portfolio. So yeah, it can be, a negative to see your bonds price from a price perspective going down. Remember too, bonds in a much different position now than they were 4 years ago when inflation went up. They have strong yields this time. Previously, rates were zero for a decade coming out of the financial crisis. So the underlying yields on bonds had no cushion when rates went up. This time it's different. And when you see the 10-year start to creep up into the high fours and potentially crossing over 5, that can be a big shift in investor mindset. Is the risk we're taking in stocks worth it when we can get, 5% on the risk-free rate?
Yeah, such a great point, Kendall. And Tom, that's something I know we've looked at a lot, is comparing the earnings yield on the S&P or really any broad measure of stocks right now to what you can get on those safer things. And I think the story now looks a lot different, to Kendall's point, than it did. What are you seeing, Tom, as you kind of look at the earnings yield versus that 10-year Treasury rate?
So yeah, the earnings yield is definitely getting closer. The Treasury rate, I should say, is getting closer to the earnings yield. The 10-year Treasury yield finished the week at 4.45%, And if you look at the PE for the S&P 500, for example, based on that, the earnings yield is about 4.5%. So they're about the same. And you could say that putting a bunch of money into stocks isn't always worth the extra risk, and you can get a similar return with Treasury yields, and then also like corporate bonds, which are at about 5 or 5.5%. And then for one of our clients, I was looking at a CD recently, and that was at about 4%. So even CD rates for a year are 4%, and for 2 years it was 4.1%. So there's definitely a lot of other alternatives out there instead of putting a bunch of more money into stocks when you don't have to.
And that's great for a diversified portfolio, Tom. To echo what you're saying is now there's more options for those that are looking to maybe round out that 40% of the 60-40, if we'll use that for an example of their quote-unquote safe money. There's other options outside of just bonds. You have things like CDs, money markets still relatively attractive for potential cash needs under a year. So it's nice when we have more tools in the tool belt to be able to deploy for clients based on their own needs and goals.
Yeah, I don't know how we ever got through the years of the zero lower bound with interest rates. It was a challenging environment, to say the least, and exiting that environment proved exceptionally painful. But I think the takeaway for me from our conversation on this is that it's better to have options. It's better to get paid to keep money safe than it is to maybe have the economic juice that comes from such low interest rates. And I would add that higher interest rates tend to speak to an economy overall that can sustain them. And so I think all of those are generally a positive, both for investors and the economy more broadly. One thing that may not quite be a positive, Kendall, is the amount of fraud, the amount of kind of security lapses that seem to take place. The FBI came out with a report recently talking about the amount and just sheer volume of things that are going on out there. We talk about it occasionally. I talk about it regularly directly with my clients, and here's some of the things they need to be worried about. But what kinds of things was the FBI seeing, and what kinds of things should our clients be aware of?
Yeah, there's a couple key takeaways I thought from that article, and the biggest one is that AI, for the argument of all the good things it's doing right now in the economy, it's also helping fraudsters get more creative with their scams. So they're getting more complex with how they're attempting to steal people's information or get them to send them money. So I think that one of the bigger things to be wary of, I don't think you can trust your messages and calls at face value anymore. You have to be able to verify some of those things independently. I think a great habit is if you get a call from someone and you're feeling off about it, or your gut's telling you, hey, this seems, not legitimate, hang up and call back on a known number that for that business. The other kind of big key things to keep an eye out for with these types of scams is urgency. It's always a rush. It's always, we need to do this now, or they're going to close your account. The IRS is going to seize your assets. They're going to make up stories and try to put pressure on you. And that's a telltale sign of someone trying to scam you. And the other thing is anything that is being roped in, with cryptocurrency is another thing they'll use. So, hey, your account was compromised with the bank. You need to put it in this crypto ATM and take your money. I mean, these should all be big red flags. So just be wary of calls and messages that you get. Try to verify the source they're coming from. Don't just assume it's from your bank because you got an email. Go to your bank's website, look at the number on your bank statement, call that number, and speak to somebody there. And just be wary about giving out information to unknown sources.
No, I think that's great. And, I often talk to clients about the steps that we take here to help them protect themselves. And it's as simple as requiring that we talk to them in person anytime they want to move money around. It's not enough to just trust the email you got from Joe that, Joe wants you to send $5,000 to his bank. Well, okay, I'm going to give Joe a call at a number I know exists and just make sure, A, that Joe's really the one asking for the money, and that, B, Joe's not asking for it to give it to some bad actor. And I think those are some of the bare minimum things that firms like our firm, but your bank, your other financial institutions should be doing. And the unfortunate reality, I think, is that as we have pushed as a society to become more and more on demand, more and more online. Well, a lot of the apps out there, a lot of the bank accounts out there, with a couple clicks of a button, let you move money around. Hey, we're going to put one more little roadblock up for that. It might not always be the most convenient thing, but it is the thing we can do to kind of help protect you from those things out there that might be trying to get access to your money. The only other real big headline this week was that the official launch of the Trump Accounts app is out there. We've had no shortage of questions from clients asking how they can get money into these accounts, and the answer for a long time from us was, hey, we don't really know. There hasn't been a lot of framework here, but Robinhood and the Bank of New York Mellon, the parent company for Pershing, have built the app now. You can go to the IRS, file the form that's necessary to get this account open, and then go back to the application or back to the website and get these accounts open. A reminder that there are some pretty significant restrictions on who will qualify for the free money. And no such thing as free money. You and I are paying for it. But it is money that for children born across certain years will be seeded directly into these accounts for them. So if you've got a kid, a grandkid, make sure that they're getting that money that they're entitled to. And then beyond that, some other programs from folks like Michael Dell, who will be seeding some money into these accounts for kids of a broader age range and from particular zip codes. But again, I think another potential tool for family members to save for kids and grandkids. Maybe not terribly excited about the branding that's been put on this one, not because I feel better or worse about the president, but just, yeah, okay, do we really need to put our name on another thing? But there are some reasons why this type of account might make sense, and I think there's some really good opportunities coming from it. And so as we kind of get more and more information on how these accounts are going to work, eventually you'll be able to move beyond just this app that's been created to other financial institutions. For now, you got to go through the app. You got to go through Robinhood and BNY Mellon. And most importantly, we won't start seeing the ability to actually fund these accounts until the 4th of July.
Well, I think one other just key distinction with it is that any child under 18 with a Social Security number is eligible for the account. So they may not qualify for the free seed money, but it's another way that parents, grandparents, families, sometimes employers, charities can contribute this money on behalf of that child.
No, I think those are important things to know, important things to recognize. It is ultimately the guardians of the child who need to open this account. Grandma and grandpa, you can't go do this for your grandkids. But again, once it's open, you can participate in funding. So, and to your point, employers, charities, all kinds of ways to participate. So I think a really good another vehicle. You add in the changes we've seen in the 529 space with the ability to make Roth conversions. Now Congress is looking at the ability to use 529 money for first-time home purchases even. There are some really big changes potentially on the horizon for how we save for our kids and our grandkids. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.